Welcome to my fourth lecture, Research of Financial Markets. So before I will discuss the next paper, I would like to give a short appendum concerning the last lecture, Betting Against the Correlation. So I would like just briefly discuss one more time what happens in table 2 of that paper. So in table 2, in the paper Betting Against the Correlation, we see a table that has two dimensions. We have the correlation dimension and we have the volatility on the other dimension. So what the authors do is they sort all stocks first with respect to the correlation into 5 groups from low to high, and then they sort the stocks with respect to the volatility from low to high into 5 groups, which gives us 25 portfolios. For instance, this portfolio here on the left hand side, here we have stocks that have low correlation and a low volatility. And what they report in panel A is the corresponding beta hat of that portfolio. Okay, so in panel A of that table, they report the beta hat estimates, so the sensitivities of these portfolios here, depending on the correlation and the volatility. And now remember how they compound these measures. So the metric correlation, they use the past 5 years daily return to come up with the corresponding correlation estimate, and for the volatility they use the past year daily returns to estimate the measure of volatility. So again, in panel A they report the corresponding beta hat estimate, so the sensitivities of these stocks in each of these groups. On the left hand side then, they report the corresponding estimates for each volatility group. They report the corresponding beta estimates for a portfolio that is long on high correlation stocks, given we are in the low volatility group, and short on low correlation stocks. So it's a high minus low correlation strategy. And these are the corresponding point estimates of the betas. This is what you find here on the left hand side in panel A. In panel B, however, this is maybe the more important table. In panel B, they report the corresponding alphas, alpha hat. And how do they do? So for instance, in group 1-1, let's say they compound the portfolio that consists of all stocks that are in this group, and let's note it as 1-1. So these are the returns of that portfolio, the excess returns at time t of all stocks that are in this group, and they regress it on the market portfolio. So they regress it on a constant alpha hat plus the beta hat times the market factor in excess form, of course. And because it's a regression, we have also in regression term a residual term, and we denote it as epsilon 1 at time t. So the point estimates in panel B are the alphas here of that regression equation. Okay, this is what you find in table B, in panel B of table 2. So, and they argue if you want to test leverage constraints, so if leverage constraints is the underlying theory, leverage constraints, that would mean that the alpha should be positive, but the alpha between low and high correlation stocks but what they report in the table is the alpha of that we would get from a regression where the zero cost portfolio here would be high minus low. So that's why the point estimates, the alphas in panel B of table 2, are negative. So what you would do, or what you would be supposed to do in order to test whether these payoffs can be explained by leverage constraints, is you need to multiply the payoffs on the right hand side here by a factor of -1, yeah? Because you would basically use exactly the other way around. You would go long in this group and short in this group, but they reported in the table the other way around. Why they do that, who knows, I don't know. Probably because usually asset pricing tests of market anomalies are usually high minus low and not low minus high. But if you want to test this theory of leverage constraints, if this is the economic driver behind these patterns, what you would need to do is you would basically test a portfolio that is long on low correlation stocks and short on high correlation stocks, yeah? And the payoffs here on the right hand side of the table would be then basically the negative, or basically negative times negative is positive, so it would be the positive, yeah? And we know from the table all of the payoffs here, irrespective of which volatility group we consider, all of the payoffs are significant. Yeah? So this strategy is indeed fulfilled, yeah? Because all of these alphas are larger than 0. Yeah? Okay. This was the appendum for the previous lecture. And the paper that I would like to discuss today is entitled On the Performance of Volatility-Managed Portfolios. The paper is published in the Journal of Financial Economics, and I told you already this is among the top 3 journals in finance. So the paper is authored from Cederburg, O'Doherty, Wang and Yang. Yeah? So what's going on here in this paper? So it deals with volatility-managed portfolios. So obviously, when you go through the paper, they cite, or they often refer, a paper from 2017 from Moreira and Moore, published in the Journal of Finance. And this paper was entitled Volatility-Managed Portfolios. But what they basically do is they extend that research. Yeah? If you go through the paper, you see they cite this paper many times. And another thing that I like with that paper is that it also cites one of my own papers that I published 2 years ago. So this is what you see when you go through the list of references. So what's the idea of volatility-managed portfolios? Yeah? Let's say we have a factor. Let's denote Ft as a factor f at time t. And this factor can be anything. It can be the market factor, it can be MKT, the market factor, it can be the size factor, it can be the value factor, HML, it can be the momentum factor, and so on and so forth. So basically they go through these 9 factors that have been also subject of consideration in the earlier paper from Moreira and Moore, the 2017 papers. But what they also do is they add a whole bunch of other zero-cost trading strategies. I think in total they were testing about 103 different zero-cost strategies. Yeah? So let's denote risk factor as Ft. And what we can do is, we can basically leverage or deleverage this factor. We can multiply it with a scalar. Let's multiply it with something. We have here in the upper part a constant c, and we divide it by sigma hat t minus 1. What is sigma hat t minus 1? Well, this is the volatility of that risk factor at time t minus 1. Yeah? So this is a monthly returns, which is common practice in financial research. So we operate usually with monthly data. So this return is given in monthly data, but this estimate here is based on daily data. So what we do basically is, okay, we have this risk factor, we have t, and we have, let's say here's time 0, and then we go at 22 days back until we are in month t minus 1. So we have, let's say, 22 trading days, and we compound the volatility estimate of that risk factor given this period here. And there are obviously many different strategies that have been discussed in the literature. So some papers they use the volatility, others use the variance, so the squared volatility here, and other papers use a longer time window, let's say 6 months time window, and so on and so forth. So there are many papers, obviously this has been a topic that has been discussed intensively in the literature. This is also why I took this latest paper on that subject as a compulsory paper for this course, so that you get the latest up-to-date knowledge in financial research. Okay, so this estimate is based upon the previous month's daily returns. Okay, so use daily returns for coming up with that estimate. So then your volatility-managed risk factor at time t is then nothing else than this product here. So another question arises, what's that C? So in that paper, they use C such that the variance of the original factor is equal with the variance of that risk managed factor. So the variance of this guy and this guy should be the same. So we can denote this part here, this part here. This is obviously depending on the current state or on the previous month's volatility. So this is basically, we can denote it as ST, which is a scaling factor, depending on time t. So we can plot it. If we plot it over time, let's say this is our scaling factor, and this is the time dimension. So what we'll see if we estimate it, given some factor, on factor volatility, so it would basically evolve over time a little bit like a random walk, okay? Depending on the current state of volatility. So we have here somewhere the average of the scaling factor, and we know when the volatility is below the scaling factor, so if the current market state of the volatility or of the factor volatility is low, then we would basically, this term here would become larger than 1. So we would leverage our position held in that factor. So when the volatility is low, the whole term becomes large, and we would be here in this area. And when the factor volatility is low, or the expected factor volatility is low. And vice versa, in this part of the distribution, the factor volatility is high. So because when we expect, or when the previous month's volatility was very high, was larger than the target rate of volatility, then obviously we would deleverage the position kept in that portfolio here. So we put In this case, for instance, we would maybe put only, I don't know, 30% maybe in that factor, and the rest of our wells we would put or we would invest in the risk-free rate. And here, for instance, I don't know, we would maybe invest 150% of our wells, so we would go to a bank and borrow money and would invest 150% in that portfolio here. Yeah? That's basically the idea of the volatility managing factors. So, and how do they assess in the earlier paper from Moreira and Moore, how do they assess if the strategy here has a payoff that makes basically sense to invest in? So, how can we determine if an investor would choose the risk adjusted or the risk managed or the volatility managed factor portfolio instead of using just the standard, the ordinary factor portfolio? How could an investor determine which is better? So let's take this away. So in the original paper from Moreira and Moore, they suggested that the risk managed or the volatility managed factor should be regressed on the standard factor. And of course, because it's a regression, we have also a residual term. So this is basically what they suggest in the standard paper. And we remember this framework here already from the Pharma and